What could 2022 actually entail for the market? What are the factors you should watch out for very closely if you're already sitting on smart gains? If you have investable surplus, how would you go about allocating that during the year, during the course of the year? The guest on the show today is someone who really connects the macros with the micros very well. He's the head of research at Nippon AMC and a fund manager with a very keen eye on macros, but at the same time, stocks and sectors is his daily bread and butter. I have Ashutosh Bhargava, who is joining me today for the chat. Ashu, good afternoon. Thank you so much for your time. A very happy new year. In fact, let's start getting your thoughts on how this year could actually pan out, which to your mind and why could be the space to watch in 2022.
So first of all, thanks Ajay, Happy New Year. Thanks for having me. So I think and I hope 2022 is a year of normalization where the cyclical recovery that we saw just before Omicron wave would continue to hold shape with lesser supply side disruption or pandemic driven disruption. That is the first and the foremost thing. I think both growth and inflation would moderate going forward. I expect growth momentum in general to sustain, led by urban consumption and Capex. So far you have seen exports doing well and urban consumption doing well, but now I think the growth leadership would probably come to Capex, primarily because of government Capex to start with. So areas like roads, urban infra, renewables, etc. And then you have private sector Capex in areas like these China Plus One and PLI beneficiaries like electronics, chemicals, pharma, metals, and some new sectors that a lot of people are talking about, data centers, etc. So you will see these sectors initially lead the Capex recovery. And last but not the least, the housing recovery. All of us are excited about it. Housing market is in a good shape. So even from the household side, Capex, which is in the form of house registration and housing activity, that would also hold up. So out of the three pillars that we all know, consumption, exports, and Capex, me or as a house, we are most positive on Capex going into FY23.
How would you play that Capex? Is it capital goods? Is it road infra, cement, or parts of realty, or a mix of both? A mix of all, actually.
I think capital goods, infra, real estate stocks, and banking. I think these are the four ways you can play. In most of these sectors, I think what we can foresee is a very strong earning tailwind. And if that comes, you will probably see all of these sectors outperforming. Obviously, one has to be selective, but we are pretty much confident about these domestic investment recovery related sectors to show very good earnings.
Fair point. For a moment, let's take a step back and take stock of the consumption or the way economy is shaping up. Just 2 days back, IMF said that for 23, they are upgrading the growth target to 8.7% from 7.5%, saying there are signs of private capex picking up and consumption is coming back. What is the shape of the recovery and what are the indicators which you are reading to ascertain that?
Now, consumption is a bit tricky. It's a multi-pace kind of recovery, if I may say, or development, we may say. It's a K-shaped recovery. I'm sure you've heard of it, wherein you have a formal sector, which is more urban, upper income consumers. They are in possibly the best possible shape. And that was getting reflected just before Omicron wave. You had, these data points like SUV demand, retail sales, credit card spend, even housing activity. I mean, this is a sign that well-off consumers, the urban rich consumers, they have very good purchasing power and confidence is also high. But you have a bigger lot of consumers, mainly linked to the informal sector, agricultural economy, rural India. So basically the low income consumers, their purchasing power has been impacted by COVID and even the previous shocks before COVID. So what you're witnessing is a pronounced weakness in that segment, the purchasing power there, and the data points that we track like two-wheeler sales or the commentary of FMCG company, for example, we know this segment is lagging behind. So on an overall basis, consumption would chug along, but there is a huge disparity within different consumption segment. And as investor, we need to be mindful of what consumption are we talking about.
Okay, let's also talk about the environment a bit. Sure, this is more about the domestic economy and the sector which you like, but we cannot move in isolation. We will definitely get impacted by global factors, talk of taper, shrinking of the taper and rate hikes on one hand, and on the other hand, the global economy is also chugging back. Export demand is looking upward, and a global capex seem to be taking shape. How are you putting that piece also into perspective?
So look, global liquidity and demand environment has helped us a lot, be it earnings on the IT side or metal side, or be it on the the valuation side. So our valuation have gone up very much in line with global valuations. So yes, that is one headwind where if liquidity withdrawal is there or rate hikes are there. But at the same time, probably we have gone into this year, if we talk about global, with very I would say pretty much large pessimism as far as global earnings is concerned. So I was just checking data for US or for Europe, adjusting for buybacks that they generally do. We are talking about low single digit kind of earnings growth. So I think while definitely some bit of valuation derating is possible, but there is a possibility of surprise, which I would personally look for in earnings per se, global earnings or local earnings. So that's the kind of tussle we are dealing with. Valuation on one side ensures that probably the return expectation should be moderate, but at the same time, earnings attractiveness or the possibility of earnings surprise, the low hurdle rate in terms of earning expectation makes us constructive on market irrespective of higher valuation. So that's a kind of environment we are dealing with. A bit confusing, I must say.
Right. Ashu, what are your thoughts on upside and downside risk? As in, on the one hand, everybody is talking about the opportunity that global economy is buoyant. But what about the downside risks? Are they factored in?
So the biggest downside risk is obviously faster than expected tightening. In the last maybe couple of weeks, the expectation that Fed will not normalize the way they were talking about like 7 rate hikes, that possibly market is kind of discounting that Fed may do lesser. So if Fed continues to hike or sound hawkish, and at the same time you have energy prices remaining firm, I think that would be big risk, particularly for India. I think because at this point of the economic or market cycle, you need continuous support from flows perspective. At the same time, you can't expect oil prices to go to $90 or $100. That would, I think, jeopardize a lot of equation as far as fiscal deficit or current account deficit, inflation, or how RBI respond. So far, RBI has been very much tilted towards growth, but if oil prices remains high and there is a significant upward pressure on bond yields, even they might move more towards the hawkish bias, which is thankfully as of now is missing. So these are the risks. These are not a base case, but something to definitely watch out for.
Ashu, also, one of the big events in the near term, medium term would be the union budget. While, it is mostly discussed that bulk of the kind of reform government is doing is happening outside of budget, but still, it is definitely a document of income and expenditure, and resource allocation on certain sectors is watched out for very closely. As a market participant, what would your key monitorables be in the budget?
The importance of budget over time has come down. So it's the important event, but in the overall scheme of things, reform is a continuous process. So that first thing that we need to keep in mind. Second thing is, in this budget, government is going with lot of unspent resources. They could not spend for a variety of reasons. So there's no dearth of resources going into this budget. So what I expect is that, government spending would actually pick up, government would show good numbers. Areas where they would probably focus on is where they talked about last year, where the execution was lacking, but intent is there, which is infra capex. And I think what is needed is to provide support, as I mentioned, this K-shaped recovery, to provide support to this low income rural informal segment, which has been impacted by COVID or other shocks. So I'm sure there was something would be coming there, either in the form of income support or, the low cost housing, both for rural or urban, population. So some kind of targeted, announcement which helps improve the purchasing power of that low income / rural segment. I think that is what is needed. So, and as I said, beyond that, it's the intent what we want to see is not so much about the numbers. And reform process is gone much beyond the budget exercise number that few years ago we used to really hooked on to. So it is important, but beyond these 2-3 areas, I would look at the bigger picture that how government continues the reform agenda forward over the next few quarters.
Ashu, one contra word. As in for the year, which sector can actually surprise the street? Where should people look for value or good bets or earning back stories? Something which people are usually not looking at that area and could be an ignored area of the market.
When I look at Nifty earnings, people are positive on a lot of these cyclical sectors. Where I think there has been a lot of pessimism that is getting built in is in commodities. In fact, FY23, FY24, this is one area where consensus expect the material sector to drag earnings, not to contribute, rather drag earnings. There is growth that people are expecting there, which I think, could surprise if this if the demand environment recovers post Omicron and liquidity still remains supportive. What we have seen the last 2 weeks, even that big consensus trade of dollar strengthening, that is also kind of reversing. So if there is one contra trade which one can look for, is look into commodities, energy, metals, and chemicals, etc. That can surprise in terms of earnings and therefore stock price performance.
Excellent, Ashu. Always enjoy chatting with you. Thanks so much for your time today.
Thanks, Ajay.